As Daniel mentioned, my name's Hunter Brookshire. I'm with Joseph Bernard Investment Real Estate. We're based here in Portland. We are a commercial multifamily brokerage, so we do apartment buildings. And we'll do residential apartment buildings as well. That would be units 2 to 4, and my next slide will tell a bit about that. But primarily we're a commercial brokerage, and so we're going to talk today a little bit about the Portland multifamily market, as well as strategies really to get into multifamily real estate investing that I think are actually more widely applicable than just Portland. But we'll focus on that to start. And Daniel, will there be a question and answer time?
Absolutely.
Okay.
It's your time, so you can really structure it how you would like.
Okay.
We could either take questions as we go along or just hold them to the end.
Let's do both. I'll try to save a little time for some wrap-up questions, and if anyone has any pressing questions, feel free to chime in. All right, so I'm not sure how familiar this constituency is with real estate in general, and so let's just define multifamily real estate. It's obviously it's residential real estate, and it's really defined in kind of two categories. There's either residential multifamily, which is 2 to 4 units, so that's a duplex to a quad, and of course a triplex. And then commercial multifamily is 5 units and up. That's really a 5-plex all the way up to hundreds of unit apartment buildings. And some of them are commercial mixed use, which means maybe they have commercial tenants on a ground floor, maybe a restaurant or retail. But what multifamily isn't is other types of commercial real estate, being industrial properties, office spaces, agricultural properties, or land. So that's just kind of the definition. We're going to look at some metrics here in Portland, and there's a lot on this slide to glean. So Portland has had incredible growth over the last decade, and it's been really one of the hottest markets in the country for probably the last 5 years. So it's an interesting time to talk about Portland, and what we're seeing now, as later slides will indicate, is a bit of a return to normalcy, coming off just an incredible growth period. So some metrics here that we measure that by are, of course, every market that you want to own an apartment in for multifamily. Some of the primary indicators as to whether or not that will be a profitable market for you will be job growth, population growth, employment, or unemployment, conversely. And some of those metrics for the last couple of years are listed here. As you can see, unemployment has been declining. So at this point, economists are saying we're pretty much at full employment in the Portland MSA. Job growth has been steadily, just steady essentially. Also declining somewhat very recently, but it's been good over the last 5 years, with really an uptick, I believe, around 2014-15. And so some of the apartment valuations reflect that. If you go down to the third from the bottom metric listed, you'll see 2016, 17, and 18 all saw double-digit growth for apartment values, up 10 to 20%, 25% even, which is not what I would suggest you expect for your apartment evaluation prognosis as time goes forward. That's uncanny growth, and it's really been a good thing. The biggest winners coming out of the Portland apartment market have been apartment owners who have owned apartments and probably purchased sometime within the last decade. Okay. Here we have a graph shown from the U.S. Bureau of Labor and the Federal Reserve economic data showing unemployment. So as you can see, it really took a spike after the kind of dot-com boom, as well as in the 2008 recession. Levels are down now again to pretty manageable levels, and they're at right around right around 4% in Portland. Getting a little more specific, comparing it with the national average, Portland did take a hit during the recession and rebounded fairly quickly compared to national markets thereafter, and has outpaced national job growth since then. Although we are, as you can see, towards 17, taking a bit of a slower growth rate than we had previously. Just over the last couple years, job growth did actually dip below national averages in 2018, has since rebounded, and remains at a relatively tepid 1.8% here in Portland. We'll get to figures on how many jobs we've added here in a moment. Population, go ahead.
Can I make a quick interjection?
Sure.
And this might be putting you on the spot just a little bit.
Please, no.
But I also, just before you came in, I asked some of the people where they're located too. And if you have any like comparing, contrasting information just off the top of your head to California, I know there are definitely people on the call that would be interested in that. But if not, that's fine.
Yeah, no, lamentably and unfortunately, I just don't know a whole lot about the local markets in California other than, in my case, what a lot of clients are telling me, which is that it's, in San Francisco and Los Angeles, generally quite expensive markets. And for a West Coast market, comparatively, Portland looks really attractive. So that's about the extent of my knowledge. I know a lot of folks from the California area actually sell primary residences and then decide to buy investment property thereafter. So they may not always be coming from an investor background owning multifamily, which is interesting. So here you see population growth has been solid in Portland over the last couple of decades. Again, took a dip during the recession, but right now we're at between the Portland, Vancouver, Hillsborough MSA, close to 2.5 million people. So one of the 100 largest metros in the country. To your question about California, where are folks coming here from? Well, California. Other counties in the country contribute to Portland's population growth, but outside of California, other notable ones would be cities like Denver, New York, parts of Florida. Although over the last 5 years, as this graph shows, the largest influx really is from LA and San Francisco counties. As well as locally, we have Marion County, which has our state capital, Salem, being a large contributor. Also Alameda County, down in the Bay Area. So all the counties you see in orange there are net inflow counties to Multnomah County, which has downtown Portland and most of the east side of Portland, Oregon, for those of you who are unfamiliar. So again, back to what I said in the beginning, the fundamentals are solid. Portland's long-term growth, I think Marcus and Millichap's annual report just came out noting it would be it's forecasted to be a top 5 appreciation market in the U.S. For years to come. And so the fundamentals are solid. Unemployment's low. The Portland Metro added 20,600 jobs last year, which was actually not a bad year. It's actually a pretty solid effort there, though it was the slowest year since 2013. So again, things are kind of returning to more of a normal, sustainable state.
Now, you just mentioned an interesting term. You said appreciation market.
Yeah.
Could you define that, and maybe what are some of the other types of markets that are out there?
Yeah, the second half of my presentation, I'll get into strategy, and we'll talk about the 4 ways anybody makes money in real estate, and that's regardless of even what type of asset class they own. But an appreciation market generally is seen as a market that can benefit from long-term appreciation or potentially short-term appreciation of the asset, which means the sales value will be higher than the purchase price you paid for the asset. And it's really easily juxtaposed with a cash flow market, although good real estate investments can attain both. A cash flow market might be seen as a lower barrier to entry market where the primary focus isn't the appreciation of the asset itself, but rather the annual or monthly cash flow gained from such an asset. So,
and I know some people actually term the cash flow and appreciation markets, they call them hybrid markets. I've heard that term.
Yeah.
Is that a common term to say hybrid, or do you just say they cash flow and appreciate?
In my daily parlance here, working and I should note that as a real estate broker, I'm licensed in Oregon and Washington. So where I'm working and focusing most of my time, I don't hear the term hybrid market often.
Okay.
Although I would probably categorize our market as a hybrid market because multifamily can cash flow quite well, especially with larger unit counts. But generally, I think the West Coast in general is seen as an appreciation market, and our property values really bear that out. So here we have just some figures on how many jobs we've added in the last couple of years in the Portland MSA. Again, 20,600 as of 2018. Where do people work in the Portland area? Well, some of the big contributors are government jobs, health and education, financial services, professional services, trade, and utilities, as well as information technology. I know obviously Intel's a big contributor to that. It's taken from Bureau of Labor Statistics, so you can check that out on their site. Construction has been a point of inflection for several reasons. So there were 7,500 units added in 2018. It's down 26% from 2017. A large part of that is something, a political consideration called inclusionary zoning that I'll talk about more in a moment. Although still, Portland again is one of the top 10 busiest metros for apartment construction. Here's a graph showing really a spike in permit applications that happened right prior to 2017, which was when a piece of legislation, again called inclusionary zoning, was put forth to Congress here, and it did pass. So I'll talk more about what it did, but essentially it's a requirement for developers to have a certain percentage of their units be available to those who are below a certain percentage of the median family income. And a controversial piece of legislation, no doubt, but what it did was actually decrease permits for the 2018 year. And we can't attribute all causality to that, so we can't say that that legislation alone was the cause for that, but certainly the political climate's contributing. So that's just a statistic as to how many new units are really being brought forth and brought to market. Expenses kind of trucking on as usual. Property taxes are really 3 to 4% in Oregon, and that's legislated also locally. So maintenance, repair costs going up, and potentially administrative costs can go up. We'll talk about factors as to why.
My understanding is that Multnomah County, where Portland is situated, actually has additional city taxes as well.
Yes, it does, and a couple of them are recent, a couple are long-standing, and we'll talk about that. Sure. The Tri-Counties area, Portland's really kind of on the trifecta, the cusp of Multnomah County, Washington County, which is where your Intel headquarters here are, and Clackamas County to the southeast, and they all have their pros and cons, so to speak. Getting into specifics of submarkets, here are some expense calculations. Really, you see that further out, some markets may suffer from higher utilities, higher labor costs. But when I'm writing a pro forma for a specific property, I typically want to see expenses go between 34 and 42% of the effective gross income, which is the scheduled gross income. That's all the rents put together minus usually a 5% adjustment for vacancy or credit loss. So if you're, and I know some other markets will kind of look at maybe more of a 50% expense ratio. That would be high in the Portland market. Here we have some specifics about construction costs. So construction and labor costs are one of the biggest hurdles to development and to value-add projects here locally. Costs have risen dramatically, double-digit figures really over the last 5 years. These are a couple different surveys that bear those out. So we're seeing between 9 and 12.8% annual change and annual increase in construction cost per square foot. Looking at costs around $200 a square foot now. And that depends on several variables, including the state of the property, the kind of construction you're doing, and other things. Yeah, so again, the biggest winners in Portland have been apartment owners over the last decade. Market cap rates, which is the capitalization rate, and I'll talk more about those metrics in a moment, is now at 5.5%. For those of you in some of the California markets, that may actually seem favorable. But there are, of course, markets in the Midwest where I think potentially double-digit cap rates are more normal. Tertiary and secondary markets in Oregon can reach 7%. maybe on average.
Can you explain what cap rate is, really?
Yeah, so cap rate is short for capitalization rate. In commercial real estate, it's often used as a measurement of several things. One, literally is a math equation. It is the cap rate equals the net operating income divided by the value or the price of the property. And the net operating income is, of course, all the rental income minus all the expenses, essentially. And so what it is it's a measure of risk for a lot of investors. Low cap rate would be associated with a low risk market, whereas a higher cap rate, although being a higher yield, may be associated more with a higher risk premium. So 5.5% is just kind of in the middle of what we're seeing right now. It's not unheard of for some of the nicer properties, A-class properties. For those of you unfamiliar, most commercial real estate's really kind of anecdotally divided into A, B, C, and D class properties, with A being your new high-end construction and D being your very difficult high tenant problem submarkets. So, 5.5 is right in the middle. That's a lot of what I see at my firm, primarily with B and C class properties, mostly 1960 to 1990 construction. There are a lot of the properties that are actually turning hands. Older properties in this area are kind of trophy properties in a lot of ways, sometimes, because they're that Victorian construction, and a lot of times have already been remodeled. Other A-class properties are new construction, just coming online. So another metric that's really easy to gauge and popular among investors is price per unit or price per door. 150,000 is kind of the new normal in the Portland MSA. That's up significantly over just the last few years. So, I had a buyer the other day ask me or say, I'm looking for things 100 a door. And I pretty frankly had to say, well, that's probably not unlikely, it's not likely to happen anytime soon in the Portland MSA. We're really in this kind of new normal phase of seeing 150 and up per unit.
Can you later, if there's time, can you talk about how can you make a deal work where there can be some cash flowing in the beginning?
Yeah, I can attempt to. There's all sorts of ways to structure a deal, and just the general philosophy around trying to get a deal to cash flow at the onset would be, I think, to put less money down and leverage it more. Okay. And it'll cash flow better right out of the gate. So, I'm sorry, it's the exact opposite, to put more money down.
Yeah.
The more you leverage your property, the higher your interest and debt service will be, therefore the lower your annual cash flow will be. So that's kind of the trade-off.
It also kind of depends on what your goals are. If I could jump in here.
Yeah, please.
If your goal is to buy a place and renovate it and then resell it at a profit, then you can look into loans that are interest only, for instance, and not having to pay the principal. This is going to increase your cash flow. So, but if you want to hold on to it longer term, obviously putting more money down is the good way to go.
Yeah.
Okay.
Yeah, thank you. That was a good question. And so now we've had rents rising rather quickly over the last 5 years. The growth on that will be projected to slow to around a 1 to 3% average. Again, vacancies at 5%. Here we have some statistics on cap rate for the local market, how it's been fluctuating over the last 3 or 4 years, price per unit, price per square foot, and generally the number of transactions. So this slide doesn't take it into account. In the upper right graph here, it doesn't have 2019, but actually 2019 number of transactions is down about 30 to 40%, largely implicated due to the political climate. So we'll talk about some of those changes that have taken place in Oregon and in Portland. As you can see, cap rates have been between low 5s and mid 5s over the last couple of years. And price per square foot going up, sitting right at about $225 right now. And median price per unit, this is multifamily Northwest, projecting it right above 170 a door.
Quick question. Sorry, I may have missed this. So what exactly does cap rate tell you?
I'll go over these financial metrics here in another slide, but again, cap rate, It's a measure of risk. A low cap rate is associated with a lower risk premium on owning that property, i.e. it's a more of a sure thing, less of a speculative investment. That's one thing that cap rate measures. Another is return. So mathematically, cap rate is the exact thing as your cash on cash return, and we'll talk about that metric. If you don't pay, or if you pay for the property all cash, if you don't leverage the property at all. In that instance, cap rate is your literal return on your investment without financing.
Oh, I see. I
Yeah.
see. Thank you.
Yeah, those are kind of the two metrics. And, another way I use it more anecdotally in my work is just as a benchmark for what a property can and will sell at. It's a really good measure of the market. If you have a good idea of prevailing cap rates, you can actually algebraically reverse engineer what a value should be, and vice versa. If you know what the value is, you know about what cap rate the property should or could be able to sell at given the current market. Here we have just a really median slide about rents per the unit mix. So obviously bigger units are getting higher rents, and these are just averages. I see rents of 2-bedroom units go above $1,600, and I've seen studios rent well under $1,120. That's just an average. Here to speak more to that is per square foot rents in local jurisdictions, some of the submarkets. As you can see, downtown and Northwest Portland really garner some of the highest rents in the city. Southwest Portland, also inner east side, and inner central east side and North Portland are also fairly high, desirable neighborhoods that can garner fairly high rent. All of these are up dramatically from even Multifamily Northwest's 2018 spring report. So again, it's looking auspicious for owners right now, for landlords. Here we're looking at vacancy over time from 2014 on per unit mix. Studios, some of the highest vacancy generally. 3 bedrooms also on the cusp. It's kind of usually just a U or inverted bell curve on that spectrum, with the lower number of bedrooms and the highest number of bedrooms being kind of outliers, slightly harder to fill with tenants, and then 1 and 2 bedroom units being the most desirable for long-term tenants. So out-of-state investments down. Again, I think I mentioned that this year sales transaction volume is down 30 to 40%. 45 sales surpassing 10 million occurred in 2018, but just 16 for year to date. And this was as of a few months ago. May have changed since then. Again, we think regulation may be part of the reason that out-of-state investors are not buying here as they were just a year ago. And part of it, I think, has to do with the dust having not settled yet. We're really in unregulated or uncharted territory with these new regulations. So I think over the next couple of years, there will be case law precedent, and we'll essentially get into more of a solid footing, grounding, where anybody who was considering out-of-state investment, maybe from California, 2 or 3 years before in 2021, 2023, will reconsider at that point because they'll have a better idea of what will come from such legislation.
There's lots of rent control.
Yeah, exactly. I always like to put this in presentations. So talking about new units hitting the markets, many of them offer incentives. This is a breakdown of by submarket, which submarkets are offering the most incentives. Those are discounts on rent, maybe paying of moving costs, free amenities, things like that to help stabilize the asset, which essentially means getting it rented out and having it rented at a certain percentage of occupancy, usually above 90 or 95% for a certain time period, maybe 1 to 3 years. After that point, there's different financing options available to the builder or the owner of the asset. So it's always their goal to get a new asset that's just coming on the market stabilized as quickly as possible. Here are the areas where they're having to offer the most incentive to do so. Again, downtown, some of the highest rent submarkets are really highly correlated with those incentives. I always like to pull a couple of slides from Craigslist and just show you examples. This looks like an older apartment, but they're saying they'll move you for free. So that's kind of an interesting perk if you're a tenant looking for new housing. Here we have one with 6 weeks free that equates to a 12.5% annual concession on rent.
Do the ones on the max line command higher rents generally?
Yeah, that's something. There's a walk score that's usually associated with most listings on both RMLS and CoStar. For those of you, CoStar is the commercial listing service for commercial properties, and it always has a walk score and a bike score. It's a lot of times kind of irrelevant to apartment investor owners, but tenants care about it a lot, and so in that way, it's seen as a desirable aspect. Okay, so getting into the politics, some of the recent, well, not politics, I should say, but legislation, some of the recent bills that have passed and affected the investment climate and really the morale here in Oregon. The biggest one is Senate Bill 608. We'll talk about that. So inclusionary zoning, I brought that up, is affecting developers and new construction. Specifically requires buildings of 20 units and above to include some affordable units. And I believe it's 15% of the units need to be made affordable to those at 80% of the median family income, or 8% of the units need to be made available at affordable rates to those 60% of the median family income. And there's punitive measures, there's fines associated with noncompliance. So that's something developers are contending with. Senate Bill 608 is, colloquially known as rent control. Here in Oregon, we were the first state of the nation to pass a statewide rent control bill, although cities like San Francisco and New York have had rent control for decades, well, years at least now. And one thing it does is eliminate no-cause evictions, and that can be, an eviction through raising rent an exorbitant amount or another reason through the first or after the first year of occupancy. And it caps rental increases at 7% plus consumer price index for the year as measured by, I think, the Fed when they put out their numbers in September. So we should be getting an update here for 2020 soon. This last year, it's essentially equated to a 10.3% rental cap increase, which is really not unreasonable at all. Most owners and all the constituents I'm speaking with don't seem outraged at that provision in any way, largely because most landlords aren't raising rent 10% on their tenants anyway. That would, in most cases, create a lot of evictions and a lot of vacancy. So not a specifically contentious part of provision of the statute. There are other considerations. Relocation expenses, usually 1 month's rent, now need to be paid along with 90 days notice given to tenants for for-cause evictions after they've occupied the unit for over a year. So we're seeing some interesting things play out with that, like some landlords trying to have tenants sign 11.5-month leases to kind of get out of that provision. And we'll see. We'll see how this plays out. We're in uncharted territory. Portland just passed a tenant screening ordinance encouraging the use by landlords of low barrier tenant screening criteria. Some of those things include caps on income to rent ratios, disregarding credit scores or using a lower credit score standard, and still admitting tenants with criminal histories, things like that. It's actually not mandatory, but there needs, for tenants that don't wish to comply, they actually have to offer applicants recourse and a way to refute it, essentially, to appeal any decisions. That I believe that takes effect March 2020. So
it's only in the city of Portland?
Yeah, it's a Portland city ordinance. The rental unit fee is also a city of Portland ordinance. It just adds $60 per unit per year for landlords. And it's a cost that they're implementing to essentially create a rental registration program. So that's their means of funding it.
Has that affected where people are looking to invest in apartment buildings?
I think it has.
For your office, have you noticed?
Yeah, I think it has. It's
looking to Washington County, maybe.
Yeah, in some ways, maybe it's goaded sellers who own in Multnomah County into selling. And our office, we have an office in Scottsdale too. So a value add we're providing to clients is moving equity out of state, both into Washington and Arizona. Really, that's clients who'd been thinking about that anyway, but I think there are some clients who the decision to sell is precipitated by some of these measures. But again, somebody's buying the buildings, so obviously there's folks, in every part of Portland, every facet, every submarket that see that area as desirable because buildings aren't typically sitting or not selling. We're not seeing a ton of sale fails. Just a few photos, rent control, and our illustrious Governor Kay Brown signing into action. Just to illustrate, not a lot of landlords are really increasing rents above 10% ever, or even above 7%. So here's a graph showing that the rent increase rate maybe just topped 7% for a quarter in 2015. So it's really not a common occurrence. It would cause really high vacancy and a lot of other problems for landlords. Again, we're projecting rent increases around 1 to 3% in the coming years. Okay, so getting onto some strategy aspects, less Portland specific, and I know a couple of you asked about these things. We talked about cap rate, cash flow. Well, what you need to do as you're thinking about investing in any asset class, and apartments included, is think about what your goals are, understand some of your metrics, understand how you're going to measure those things, decide for yourself whether you want to invest locally and perhaps be able to go drive by your building and keep tight tabs on it, maybe even manage it yourself, or whether you're going to look nationally to other cities outside of where you live, whether you want to take on partners and have, if you want to do syndications, have general partners or limited partners involved. If you want to get creative with financing, perhaps looking into hard money lenders or personal lenders to finance properties, or doing conventional loans as well. And whether you want to self-finance, do you want to use your money and put it down? Or do you want to, again, get creative and find other ways? Going into a couple of these metrics, cash flow is really just all of the scheduled gross income, so all of the rents and other income, could be laundry or fees, minus a certain percentage for vacancy. I usually write 5% in my pro formas. And then the other operating expenses, which are going to be things like your utilities, maintenance, taxes, but not to include capital expenses, which would be long-term expenditures that you actually capitalize on your taxes, things like new roofs, new driveway, things with a useful life that can be depreciated. And what you end up with is your net operating income. From that, you subtract your debt service if you've leveraged the property, which of course many people do. And from that, you get your cash flow, which is it's a measurement usually associated with a time period, either monthly or most of the time annually. Your cash on cash return is essentially it's the cash flow divided by the cash that you put up for investment. So this will be expressed as a percentage, and that's a pretty popular metric. Obviously, your cash on cash return will be higher if you've invested a lower amount. So if you've leveraged your property versus paid for it full in cash, you'll have a much higher cash on cash return. Internal rate of return, that's IRR, is similar to net present value. So it's kind of complicated, but it's looking at the future, the discounted future cash flows and their relation to your current value. So you're discounting future cash flows, which could be irregular, and those are your cash flows over years in the future, and potentially the cash flow of the year of disposition, which is the sale of the asset, and putting those in terms of a present value, and it comes down again to a percentage, a number. There's a great book on this, and let me see if I can remember it before this is over, that I actually used to help explain a lot of these metrics. Return on equity is one I often like to talk with clients about, and it's your cash flow, typically cash flow after taxes, divided by the equity in your property, measured as the resale value minus any mortgage balance. So it's a good use, I think, to see where your equity is best, is put to work the best. So typically, return on equity goes down over time, and that's actually because as your cash flow rises steadily but rather slowly, your equity in the property will rise quickly, thus kind of offsetting that metric there. And it really precipitates the question, is this equity best used in this property as it is currently, or would it be better served in another property? So that's kind of a measure of owning real estate over time. Any questions about any of those?
I was just going to make the comment that even if you're buying single-family homes, you can view your investment through these metrics and apply them just as well.
Yeah, absolutely, and it's a great exercise to do that. I think if you're probably looking at single-family homes and just getting into real estate investing, these metrics are, they're not specific to multifamily. Although I think maybe IRR or cap rate might be a little bit of overkill for some investments, single-family home investments. But essentially, the bigger the building, the more robust a pro forma and the more analytical a investor will typically be when analyzing a investment.
Right. So if you just have a single family home, you might be good just calculating, hey, what's my cash on cash return? How much am I making, on a monthly or an annual basis?
Yeah, absolutely. And I think same goes for 2 to 4 unit residential properties. Something I should note about residential multifamily properties is 2 to 4 unit properties, why they're called residential multifamily and not commercial multifamily, again, is they're eligible for those residential loans. So you can use FHA loans, conventional Freddie and Fannie loans to get into those types of properties, whereas you'll need commercial financing to buy multifamily properties of 5 units and higher.
You usually get those Freddie and Fannie still, or?
They do. Well, actually, that's a good question. I think they do back some of the commercial loans, but the standards for underwriting are completely different. So typically in commercial underwriting, the lenders are looking more at the property rather than the investor themselves, although it is a misconception that they don't look at the investor at all. Typically, commercial apartment investors will need good credit, proof of funds, proof of down payment, potentially up to 15% reserves, cash requirement, and a net worth greater or equal to the loan.
So how does someone who's purchasing an apartment building solve that puzzle? How do they solve that puzzle? How do they
get the down payment? Yeah. Well,
like for example, in my case, I already have 7 units and different. I want to buy a commercial property, but I don't want to use any of those. I want to. So I'm wondering how I can solve that puzzle.
Well, for the net worth requirement, all the assets you own will be taken into account, so that's helpful. Cash reserve requirements, you kind of just need that. It's really a bank statement you provide to your lender. And we'll talk about how to look favorable to lenders here in a sec. But there's a tool called a 1031 exchange where you can actually parlay your equity in a current building and defer taxes on it. 15 minutes left. Okay. Into a larger building. And that's a wonderful wealth building strategy that we'll kind of go over here in a sec. So 4 ways people make money in real estate, multifamily acquisitions included. So you have cash flow, which we went over. The pay down of principal, that's when you leverage a property, you take a loan out on it. Obviously, part of every loan payment every mortgage payment you make thereafter will be interest. Part of it will be principal. As that principal is paid down, you then retain the equity in the property as an owner. So when you're having tenants pay the principal for you, they're essentially subsidizing your mortgage and helping you gain equity in your property. So that's one way you create wealth. Another is tax benefits, which is really by far the most complicated and one of the most interesting ways that people can create wealth in real estate. We'll talk about some of the ways they do that. The icing on the cake, I always call it, should be thought of as appreciation. We mentioned how in Portland, likewise really everywhere, all the major metropolitan areas on the West Coast, Seattle, the Bay Area, Los Angeles, San Diego, are all appreciation markets. And appreciation is just the increase in value and really the difference between the purchase price and any resale value or current market value of a property. If you were to own it for 5, 10, 15, 20 years, it's highly likely to appreciate over time. Although it is a bit of a gamble, and investors do call it gambling. You don't want to bank on appreciation only because, as we saw in 2008, there are market forces that can cause properties to lose value. And that can be an incredibly dangerous situation where you end up owing money to the bank and your property could be underwater. So just be wary of investing on appreciation alone. So here we can talk about how to be really a strong buyer from the perspective of obtaining loans and also looking favorable to the seller and getting an offer accepted. One thing I always recommend is to pre-qualify for a loan. Talk to lenders up front before you even start looking for properties. They'll tell you about things like the income and reserves requirement, down payment requirement, and let you know about what loan you might be eligible for. I think it's a wonderful idea to talk with a mortgage broker, actually somebody who liaises with multiple lenders, so you're not hemmed into doing all the work yourself, because if you are going to work with lenders, you should work with multiple to kind of figure out which loan products might be best for you. But B, also have somebody to filter any surprises from the lender. And this is helpful during the acquisition process too, i.e. once you have a property under contract. A mortgage broker can often walk you through what the next step will be, what the lender's expectations are, and if for any reason something goes sideways, potentially can help salvage the deal by connecting you with another lender who may in fact be a better fit for the acquisition you're trying to accomplish. Here we have just an example of pretty contemporary rates here. So as of September, just per one source, these are some of the rates that you can expect on multifamily properties, looking at different LTV, which is loan to value ratio requirements, and you can think of that as the amount the bank will actually loan on a property, with the difference being the down payment that you'll make up, presumably, unless you request the seller to carry a second mortgage or something creative like that. Go ahead.
You have two columns. One's multifamily, one's commercial. Are you talking about?
Yeah, absolutely. So multifamily properties are actually seen by a lot of lenders as kind of an in-between commercial, although they are considered commercial, 5 units and above, and residential. And they're actually eligible for favorable rates over, say, an industrial or a retail or office space property.
So the column here where it says multifamily, how many units are you?
5 and above.
Okay.
Yeah. So this is commercial multifamily rates. And it's going to vary based on the property and the buyer. So lenders look at a couple things. They look at loan to value. Again, that's how much they'll lend out on any given property, where you have to make up the difference. And they'll look at debt service coverage. That's the total income from the property. Is it going to be able to cover the mortgage payments? And they typically want to see 1.15 to 1.3% debt service coverage ratio. So that means that on a property with 1.3% DSC, they're going to see income that can support 30% more than the mortgage, essentially. And that's an important underwriting factor for them. Buyer's resume is also a factor. So a lot of folks who get started in multifamily start with smaller properties. It really just makes sense. There's obviously monetary constraints to having your first deal be a 100-unit building. But they want to know that maybe you've owned a property before and maybe you've managed it. Maybe you know how to liaise as an owner with management companies, and that helps them feel confident in their investment in you. Okay, so some of the ways that you may actually want to look at disposition of your property before you even buy it. I think it's wonderful to start with the end in mind. And what that really means is look at how you're going to sell your property in the end. How are you going to make money on it? how long do you want to hold it for? What's the optimal holding period? Some of those aforementioned metrics like internal rate of return can help you calculate based on your projected.
We ended at 1 o'clock.
Oh, 8 minutes. Yes. Okay. I'll try to leave a few minutes for questions here, but this is kind of the meaty part of the presentation, so I just do want to cover this real quick. So how do you structure your disposition? And just plan for that going in. I think it's a really good practice. So you have 3 potential options. Of course, there's more, and each of these is really an umbrella. There's many ways to do each and every one of them under deal structure, but the Internal Revenue Code 1031 provides for what's called a 1031 exchange or a Starker exchange, and it's a way to defer capital gains, which is of course the tax you pay on any investment that you sell after having owned it. So it's a way to defer, not pay, but just put off paying your capital gains tax. What's interesting is it can be done an unlimited number of times. So some folks use a swap till you drop strategy to essentially do multiple 1031 exchanges over time and essentially indefinitely defer their capital gains tax that they would otherwise pay. It's a great way to parlay their equity into a larger building and make a 25% down payment on, say you're selling a 10-unit building, potentially a 20-unit building. And otherwise, you may not have been able to afford that 20-unit building by itself, but it's a great way to grow your equity over time.
I like that. Swap till you drop and
swap
till you die.
Yeah, refi, exactly, yeah. Also, a 1031 exchange is attractive to those with heirs. There's an aspect called a cost basis of your property. Adjusted basis. It's an accounting principle. It's not a real cash number, but essentially, as you take depreciation on a property, your adjusted basis is reduced over time, over each and every year. And if you have a low or no cost basis remaining in your property, when you pass away, your heirs inherit your property. They actually get a stepped up cost basis for the property, which means they don't pay capital gains tax, or at least the depreciation portion, when you let them inherit that property upon your demise. So kind of morbid, but could be really good for your kids. Another good tax strategy. An installment sale is a way to spread tax burden over many years and earn interest on your money. You can get typically a point higher than conventional interest rates from a buyer, and that can be a good way to not incur all of your taxes as one lump sum, therefore putting you in a higher tax bracket and remain eligible for other tax deductions. All these are absolutely things you'll consult your CPA with to develop a strategy, but as brokers, it's good that we know them and really recommend them to buyers before they go in and buy a property. Also, capital gains isn't the worst thing in the world. The government needs money. We need to fund our roads and schools and hospitals and all that. So sometimes it's not the worst thing to just go ahead and pay it. And you can still make a sizable gain with really a great return, even compared to Wall Street, by going out and paying your capital gains. In Oregon, as you can see, our capital gains rate is 9%. So it's calculated as the sales price of the property minus any costs like closing fees or brokerage fees, recording fees, things like that. That's the net sales price minus the adjusted basis. That's the taxable gain, and then that's actually divided into 2 portions. Your depreciation, which is recaptured. Presumably the government assumes you've taken depreciation on your property over the last couple of years, so they recapture some of that. It equals a 34% total cost, and the capital gains remainder is 20% for highest tax bracket earners at the federal level and 9% in Oregon. So,
do you want to take questions? We got 4 minutes left.
You have a business card?
I do, yeah. I can make this available and we can go through this really quickly. Yeah, I would like to take questions, and we'll kind of skim over some of the tax 1031 things here.
Yeah,
I tried to cram quite a lot in here.
I probably didn't prepare you. I don't think I'd actually told you it was 1 hour long.
No, I think
I said 12 to 1 maybe.
Yeah.
Can you come back?
Yeah.
Well, and again, I'm not a tax expert, so that aspect of making money in real estate is really important to consult CPAs and legal advisors on. But yeah, why don't we open it up to questions? Does anyone have any general questions about the Portland market or just ways to get started in funding your multifamily deals?
Yeah, is there a book I'm Patricia and I'm in Chandler. Is there a book that you could maybe point me to for somebody that is new getting into this and new into multifamily?
Yeah, there's one I really like. It's called Cash Flow and 36 Other Financial Metrics. I think it's by Frank Gianelli or something like that. He has a kind of an Italian sounding last name, and that's a wonderful book that I've gleaned a lot of kind of metric knowledge from.
What was the title again? Sorry.
It's Cash Flow and 36 Financial Metrics Investors Should Know About, or something like that. Google it. And
Yeah,
it's on Amazon.
I'll Google it and put it in the meeting notes for you.
Thank you.
Yeah, that's a good one. All the Rich Dad books, I think, are really good for beginners. Cash Flow Quadrant is a good one. Also, industry periodicals. I gleaned a lot of this information from Multifamily Northwest. Some of the national brokerages, Marcus and Millichap, Colliers, have quarterly or annual reports. The Barry Apartment Report is a local source for metrics and things like that.
Thank you.
And if you could put your name in the chat, just because I'll follow up with you in email and make sure you get it.
Sure.
Okay.
Sure.
All right. Just to say really quickly, if there are any more questions, I'm sure you can stay around for a minute or two.
Yeah,
but,
but sure.
Before people drop and go to their next meetings, I wanted to say that next week you guys sound like you've requested basically just how to do single-family property analysis, or how to determine whether a house is a good purchase or not. So I'm going to try and find somebody to talk on that, or I could talk a little bit on that myself. We'll see if we find somebody or not, but it'll be, again, happening Friday at noon to 1. So thank you very much for everybody for coming. And if anybody has questions,
Yeah, I can-
stick around for a little
I
bit.
can stay around for 10. Does anyone else have I can answer here?
Hi, my name's Michelle, and I'm located on the East Coast. And I don't know if you know much about the real estate situation on this side of the ocean or the country.
Where are you located in the East Coast?
In Virginia,
Yeah.
Intel has a little satellite office. And so I own 2 properties, and I'm trying to expand into perhaps apartments. And so I'm very new, and that's why I brought up the issue of rentals, do's and don'ts, and the pains that I've had to go through with rental property companies. So I wondered if you had any information about the East Coast. It seems to be more expensive to buy out here.
Mm-hmm.
But I don't know if there's a way to get educated on that. Like you said, perhaps I could buy in Portland instead. But how does one go about doing that if they don't live out there?
That you know what? That is actually a great topic to talk about. How do you do remote investing? And
I can wait too.
Well, there's a lot to say on that topic, and actually I'm an investor in properties down in Texas, so I do that quite a bit. And really, without going into a really long explanation, it's really about finding a team that's local that you trust. So finding your broker,
Right.
finding your investors, finding your property managers, and managing your property managers is going to be perhaps one of your hardest tasks. Finding a good
Yes, it's been painful.
Yeah, absolutely, can be.
And it's been painful because I've been managing my property more than they've been managing my property.
Yep, that's not uncommon.
Wow. Well, that's good to know.
I would absolutely second what Daniel said there, and I think there's several members of your team you want to really approach and have locked down on speed dial before you make an investment. And this depends largely too on what kind of a property you're getting. If it's a smaller property, it may not need as intensive management as a larger property would. But I would probably reach out to a broker or a property manager first. With the caveat that you should actually probably talk to local investors before anything else. I think most investors are really forthcoming with their experience at the very least, and in some cases their local market knowledge. So just consulting, a local investors meetup group, I think is a really good way to kind of get a thumbs on the market.
You know what? One really practical thing you can do is there's a website out there called Bigger Pockets. And
yes, I've joined and bought their books.
There you go. They have extremely useful books, and their forums go back for years, and there's people on it from all over the country, and so you can literally cruise around in their forums for hours and find good information.
Very good.
Tell you what, I also wanted to start a discussion on out-of-state investing on the Inside Blue group. So I'll start a forum thread on that, and I'll post on it because I've got things to say, and we can see if we can get some other people involved too.
That will be great. Thank you very much.
Yeah. So the book was by Frank Gallinelli, Gallinelli, and the title is What Every Real Estate Investor Needs to Know About Cash Flow, and 36 Other Key Financial Metrics. And I've read that book too. It's good for just going over like how to calculate all the metrics and what they're good for.
Wow. Okay.
All right. Thank you, everyone. Oh, for those of you that are still on the line, let me know if I'm being effective through Inside Blue in getting a hold of you. I'm finding Inside Blue kind of difficult to work with, and yes. I know the first meeting we had, 30, 35 people on the line, and this meeting I think we've dropped down a little bit. So I just want to make sure that I'm doing the right things as a community manager in order to grow this community. So if anybody out there has tips or hints or has experience with it, I'd love to talk to you as well. All right.
Thank you. Thank you for the presentation. It was great.
Yes, thank you.
Bye.
Bye-bye.